Hi, I'm Rowland for Money Markets TV. How would you like to make $22 million? Better yet, how about making $22 million with no extra work? You're probably saying, sign me up. Today, I'm going to tell you about a company that made that much and more just last year. But first, let me give you some background. As I've mentioned before, exchange traded funds have both internal and external costs. ETF expenses tend to be lower than actively managed mutual funds because most follow an index. They don't need to pay for stock picking. But what investors often forget is that indexes aren't free. They belong to an index provider who gets paid by the ETF. And this brings us to that $22 million easy money deal. The largest, most actively traded ETF in the world was also the first U.S. fund, the SPDR S&P 500, based on the Standard & Poor's 500 index. According to its prospectus, SPY pays S&P an annual licensing fee of $600,000 plus 3 basis points on the ETF's assets. For the year ended September 30th, 2010, this added up to $21.9 million, and it's on course to rack up even more this year. This is a great deal for Standard & Poor's. They created the index way back in 1957. Now, they still have to calculate and maintain it, of course, but that's fairly simple. So, what do SPY investors get in exchange for their $21.9 million? Answer: the same list of stocks that is freely available to everyone. Now, let's dig a little deeper. SPY's total operating expenses last year were $79.2 million. That means about 28% of the fees paid by SPY investors went to Standard & Poor's, which did practically nothing but cash the check. Now, don't get me wrong. I think S&P has a right to make money from its proprietary knowledge. But I would also argue that most SPY shareholders don't know how much their ETF is paying its index provider. The numbers are buried in fine print. This means that even at what seem like rock-bottom fee structures, the ETF business is immensely profitable for sponsors and other service providers. And that's why we've had a flood of new ETFs the last few years. It's also why money managers like BlackRock are trying to get their ETFs to follow their own in-house indexes instead of those run by third parties such as S&P. Normally, the Securities and Exchange Commission likes to keep the index providers separate from their fund sponsors to avoid conflicts of interest. But now, BlackRock wants to handle all indexing functions for its iShares family of ETFs internally. So, if the SEC says yes, will BlackRock reduce its fees to reflect the savings? I doubt it. Their goal is to help their own bottom line. Any benefit for ETF shareholders is an added bonus. In this regard, the ETF industry is following the same path as countless other sectors. Big companies grow by cutting out the intermediaries. In theory, this competition helps consumers get a better deal. Time will tell what happens in this case. Meanwhile, I'm grateful for the innovation of ETF and ETN providers. We have a wealth of choices, and that's a win for everyone. I'm Rowland for Money Markets TV. Thank you for watching.